Welcome to the Sykes & Company PA video blog.
Well, from a seller's perspective, if a seller has been an S corporation for at least 5 years, as most entities are, then the selling of those assets creates a taxable transaction that works something like this. The inventory that's sold, obviously, it's sold pretty much at cost basis, so typically there's not a taxable transaction there of any significance. The furniture, fixtures, and equipment that you buy in a transaction, if they are fully depreciated, that's if they are fully depreciated, and if there's value assigned to those from a selling perspective, then the seller will have to pick up that amount of money allocated to those assets as ordinary income because those assets have previously been depreciated. That's a little bit of a negative for a seller. The values associated with the goodwill / scrip value, typically that becomes a capital gain transaction. If there is basis in those asset purchases, meaning that the seller has previously bought files or has some type of cost basis involved in that, he is or she as a seller will be able to deduct that from the gain on the sale of that, but that becomes a capital gain transaction. So those funds typically flow into the S corporation, and then the corporation typically at some point in time is liquidated with the funds passing back out to the seller without double taxation. That's typically in a transaction where there's an S corporation involved. If the seller is a C corporation, it works entirely differently. The corporation itself pays taxes on those assets that I just described. Then the corporation goes through a liquidation process, and the taxpayer is then double taxed as he takes a liquidating dividend distribution back out from the sale of the assets and the ultimate liquidation of that entity as time goes on. So it becomes a very careful planning process that has to be put in place by both the seller and the buyer. But there are definitely definitive ways to do this to mitigate taxation or to help you if you're the buyer, depending on which direction you go. Really, the happy medium is a more complicated process that both the buyer and the seller probably need to hear this, in that there's a Code Section 336E that if the seller is a S corporation, been an S corporation for at least 5 years, he can sell his common stock. The buyer is able to mark to market, that's mark to market, the value of the assets that he is buying as if he were buying the assets only at prices that he and the seller agree to, and is able to keep the entity intact and to be able to depreciate those assets once again that he's buying, amortize the goodwill scrip value over a period of time, and keep the same federal ID number, the same DEA number, the same MPI, NCPDP, and all contracts in place. It is a highly complex transaction from a tax perspective and from a legal perspective structuring this, but that becomes kind of the happy medium. A sister entity to that, something called a Section 338H10 that works something similar to that, except there's a subsidiary entity that's set up, typically an S corporation, to purchase the stock of that entity, but the same type of thing takes place. Both of which are very complex transactions, but these two transactions somewhat become the happy medium.
Thank you for watching. If you enjoyed the video, we invite you to subscribe to our YouTube channel.